G'day folks, welcome back to another update for the S&P 500 and the Nasdaq. Now you're probably well aware the trends on both of those are still in a downtrend. We're going to introduce some back testing as well, so stay tuned for that. Before we go any further, make sure you hit that like and subscribe button to support the channel. In terms of the outlook as of today, March 12, the Nasdaq Composite fell 4% on Monday, making its worst day since 2022, while the S&P 500 dropped 2.7%, reaching its lowest level since September 24. For economic indicators, investor sentiment is dampened by fears of a potential US recession, exacerbated by recent tariff implementations and the prospect of a government shutdown. For corporate earnings, despite market volatility, earnings forecasts for the S&P 500 project growth of 7.3% for Q1 2025 and 11.6% for the full year, though these figures have been revised down since December 31. Investor behaviour: the current environment of uncertainty and fear is driving market distress rather than poor corporate earnings reports. As always, we start with the long-term trends. So long-term, you can see there the S&P on the monthly has been very bullish and it's starting to pull back towards the moving averages. Now I've drawn a Fibonacci here, and that's because of this bearish divergence, lower highs on the CCI, and it's been in effect since the start of 2022 versus higher highs on the price. And that target area is at 23.38% of that Fibonacci range. Now I've drawn another smaller target there. If you take that Fibonacci and take it to that low, that's that smaller range there. So there's two ranges there. It may possibly bounce out of one of those. Very likely, looks like it's about to hit that first range in the next. So again, bearish movement on the monthly. On the weekly, also some bearish divergence. Again, further downside on both the CCI and the price, broken through the moving average range. So bearish on the weekly, and on the daily, we've hit this resistance up here at 61.47, and it broke through this descending diagonal trend line. Now it's been below that moving average on the price for some time now, and also below the CCI moving average range. So very strong bearish outlook so far. Now I haven't drawn any support lines on this one yet. The latest support is down the bottom here at 50.90. Look, it may well get down there the way things are going at the moment. But if we look at the intraday charts, go to the 1 hour chart, there's some positive light. We've got a bullish divergence here on the 1 hour chart, the higher lows versus lower lows on the price. And I've drawn a target here, and that target is, if you're a regular of the channel, you know that I take it back to the previous high in this case, and that's at 23.38% level. So we expect it to hit that range in the coming hours, very likely, if this divergence plays out. The price can still drop, so as long as the CCI keeps rising, then we're going to consider that a bullish divergence. So what I've got here is the back testing for the S&P on the 1 hour time frame. So we take the trades in the direction of the daily. So back here, for example, I've got the back testing started when this CCI broke above the moving average range, and so did the price, and that's indicated by this period back here. So on the average down approach, you would have taken those trades. Each of these little bars represents entries and exits, and this one on the average down approach and demonstrates where you would have added positions to your trades when the price went against you. Now, beginning at that point there, you would have closed out your positions where those X's are marked, and that's indicated by the daily where it breaks into that moving average range. So you would have taken taking trades at that point there. Now, if you took trades up to that point on the stop loss approach, you would have been, the baseline's 100,000, so you would have been down about $40 odd on that one, and this one you would have been up $5,800 on the average down approach, because you averaged down quite a few periods back here. Now, you wouldn't have taken any trades in that period there, because again, the CCI is below the moving average range, and then you possibly, I've got a question mark here on these trades, because you possibly could have taken a long trade there when the price and the CCI broke above, and that you would have gained those little periods there, but then you would have started taking short trades from that point on, and I'll demonstrate on the short period. So here I've got the back testing for the short periods, and I've got it marked here when the CCI and the price broke below the moving averages of the daily. We would have started taking short positions from these positions back here on the 1 hour time frame. So again, the top one here is the stop loss approach, and this is the average down approach, and each of these bars represent entries made, and these ones on the average down indicate where you would have added to your positions. So on the stop loss approach, you still would have been throughout the whole period, and again, if you started with a 100,000 baseline, you would have dropped by about $200. You made a bit of a profit back in some of these areas, But on the average down approach, you would have made 11,957 in your trades if you took the average down approach. So a similar story for the NASDAQ on the monthly. It's been very bullish now for some time, obviously, but now we've finally broken to the downside on the CCI in accordance with this bearish divergence. And you can see that the price is pulling back towards that moving average. So again, if I was to draw a target for this, I'd take it back to probably this area here on the monthly. I wouldn't say you've got to take it back to where before that divergence started. That's why I'm choosing that area. And the very closest retrace would be somewhere in that range there between the 23-38% level on the monthly. On the weekly, we've got another bearish divergence. The price and the CCI both broken below the moving averages. And again, for this one, if I was to draw a Fibonacci between that high and that low, you can see that's already broken into that range. It depends where you drew that Fibonacci. Let's take it back to this low here. It's already hit that 23% as well. So it could possibly bounce, but at the moment, the way things are going with the markets, I would doubt it's going to rise. I would suggest it's going to have further dip to the downside. On the daily, we had a few divergences here, and the latest one was back here between those peaks versus higher highs on the price. And that's already pulled back. And if I was to draw a target area, you can see there it's fallen at the 61% level. It's resting on there at the moment. That's 61%. And these Fibonacci's are very critical because more often than not, they actually find a place to rest. You can see even that wick on that one rested on the 50%. This period back there rested on the 38%, and this one's currently resting on the 61%. So if it falls much further, we might see a bit of a retrace possibly. So let's look at the intraday and see what that's telling us. So again, predominantly bearish trades only to be taken at the moment. And at the moment, do we see, yeah, you can see there we had each of these little periods can be treated as bullish divergence. There was one back here. But even if you want to take a very long-term view of it, you could even probably do something like that. And that would be the same period going back to that area. So again, similar to the daily, this is a bullish divergence. If we were to see a rise on this one, possibly, then we want to see a Fibonacci retrace. Let's go back to that high there. At the minimum, we could see a retrace to that 23-38% level. That also coincides with this diagonal descending trend line as well at that 38% level. So very likely we could go there. Now, I don't trade these. It's a bit of a gamble because you're trading against the trend. I like trading with the trend. So again, just be careful. These divergence, when I'm showing you these divergence, both bullish and bearish, are simply an area to be possibly getting out of any short trades if you're in short trades at the moment. So looking at the back testing for the NASDAQ, similar to the S&P, we start taking short trades from this period where the CCI breaks below the moving averages, so does the price. And that's indicated by this period back here. So for the stop loss program, you can see those single trades made and plus the average down approach. So for the stop loss program, generated $371 versus the average down approach generating $6,466. Now, obviously, you've got to be careful if that goes against you. You've got to tighten and stop the trading on the stop loss, the average down approach ASAP. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching and see you in next week's video.